Hello, everybody. This is Sunko, the Korean bro. Today is 2024, February 4th. And let's see. Articles, okay? One magnificent stag that turned $10,000 into $1.2 million. Costco, okay. Costco proves that seemingly boring businesses can be huge winners. Investors looking for a next winning stock should look at historical winners. This could result in identifying unique insights that have helped contribute to a company's success, which can be applied when searching for businesses to buy. You probably struggle to find companies that have rewarded shareholders as much as Costco has. In the last 30 years, the top retail stock turned $10,000 into nearly $1.2 million, including dividends. This gain absolutely trounces the S&P 500 and also composite index. Costco's been a great investment in the past, but it's hard to tell if this will be the case going forward. There's not traded at an expensive valuation, a price earnings ratio of 47.3, which is well above its trailing 10-year average of 33.5. I think shows that the market fully recognizes how wonderful a business Costco is, and there's no margin of safety for investors. Hmm. However, a valid argument can be made that because this is such an outstanding company, it might still be smart to pay a premium to be a shareholder. I don't see any reason to believe that Costco's competitive position is under any threat of disruption, which reduces risk for investors. The ultimate question of whether or not to invest depends on how much growth you think this company can achieve. What will Etsy stop in 5 years? Etsy. Brookfield, we have Brookfield here. Etsy has only recently been able to make much needed refinements to its e commerce platform. Many of these initiatives could take years to demonstrate their full potential. Investors with a long term mindset can use Etsy's stock recent witness as an entry opportunity. Interested investors should worry less about specific long term price target and instead have the faith in the premise of stepping into high odds, high quality picks and then just leaving them alone. That being said, analysts' current 1 year consensus price target of $81.72 is still 22% above Agis shares present price. There's not a bad tailwind to start your journey with. Investors guarantee to earn positive return in the stock market the longer their holding period. There are numerous index funds and ETFs that provide low cost exposure to the S&P 500. 12.9% including dividend. That's a super return that exceeds the market historical long run average of about 10.2% per year. But as we stare at a new peak level, it's understandable that investors might think returns will not be great from here. Over a 1 year period, there's a 73% chance of positive return at market, but this figure increases as we extend our time frame. Hmm. So it's not a good time to invest. Hmm. Okay, let's see what else we have. PepsiCo stock 5 years ago. Um, Mastercard, Railway, Visa system, hmm, Viva systems, Abbott Laboratories, uh, Abbott Laboratories, and Johnson and Johnson. Mm, Sure thing, as you'll see as an investor, the Vanguard S&P 500 ETF is a great low-cost ETF that even Berkshire Hathaway has in its portfolio. Getting started is the most crucial step. Time in the market creates compound returns. The sooner you get started, the more time you have for that small money snowball to become a giant asset builder thundering down the side of the mountain. So people often get busy in the grand scheme of life. You work hard for an education or to build a career. You want to get married, have children, buy a house and new cars, and treat yourself along the way. I get it. For many people, $500 will allow them money to cough up monthly, but the longer you put off starting to invest, the more work you will have to put in later to reach the same goals. So whether you're retirement planning or building wealth in general, getting started as quickly as possible is the easiest path to your financial goals. This is the recipe right here. Investing doesn't have to be complicated. You just have to get started. Okay. Uh, what else we have at yahoofinance.com? Hmm. Stay away from your styles. Ask because it helps investors separate the market's top performers from the rest of the pack. For instance, the FANG acronym was coined by CNBC financial analyst Jim Cramer in 2017 to describe five of the largest technology companies at the time. It should come as no surprise that any growth stocks named the AI5 would include NVIDIA. Its 800 data center GPU chip is the leading hardware choice among developers to build, train, and deploy their AI models. In early 2023, HSBC analyst estimated NVIDIA had a 90% market share in that segment. Its financial results appear to back that up. In recent fiscal 2024 third quarter, NVIDIA generated $18.1 billion in total revenue, which was up whopping 6% from the year ago period. Its data center revenue accounted for $14.5 billion of that, which marked an increase of 179%. Those incredible growth rate helped Nvidia stock surge 239% last year, and the upside momentum carried into 2024. Nvidia is now gearing up for the wide release of its new H200 data center chip. When it comes to inferencing, which involves feeding an AI model real live data so it can make predictions, the H200 is up twice as fast as H100, plus it consumes 50% less energy, so it's far cheaper to run for operators of centralized data centers. Considering Nvidia is struggling to keep up with demand, the strength in its business will likely continue throughout this calendar year. It certainly deserves its spot in the AI 5. Meta Platforms, Microsoft. We know one thing for sure, Tapper didn't buy these stocks just because of the recent generated AI buzz. For example, he's owned Meta since 2014. Um, hmm. Costco, okay, Costco, Amazon. As the fifth most valuable company in the world, with a market cap of $1.7 trillion, it's probably not surprising that Amazon is on this list. The company is a behemoth in retail and tech thanks to its popular e-commerce website cloud platform. However, one of the best reasons to never sell this stock is the retail giant's ability to successfully navigate a market downturn. Amazon was hit particularly hard by macroeconomic headwinds in 2022, which led its stock to fall nearly 50% during the year alongside steep profit declines. The challenging period saw Amazon immediately begin restructuring its operations with a priority on profits. Cost cutting moves like closing dozens of warehouses, thousands of layoffs, mm, cost-cutting moves like closing dozens of warehouses, thousands of layoffs, and shuttering unprofitable projects like its telehealth platform Amazon Care have been instrumental to the company's recovery. In the third quarter of 2023, Amazon posted revenue growth of 13% year over year, beating Wall Street forecast by $1.5 billion, while operating income more than tripled. Meanwhile, the tech firm's free cash flow has skyrocketed 427% over the last year to $70 million. Furthermore, Amazon has a promising outlook in the booming AI market. AWS leading 32% cloud market share could see it leverage its massive cloud data centers and steer the generated artificial intelligence market in its favor. This chart shows Amazon could be one of the biggest bargains in tech right now. Okay. Its price sales ratio is lowest among heavy hitters like Nvidia, Microsoft, Alphabet, and Apple, indicating shares in Amazon currently offer the most value. Price sales ratio is one of many valuation metrics for stock. The ratio describes how much someone must pay to buy one share of a company related to how much that share generating revenue for the company. Okay. The lower the PS ratio, the better. So price sales ratio, okay, can also be used for comparing companies, including unprofitable companies against one another. Here, for example, is a comparison of two cloud computing solutions, that Snowflake and Datadog. More expensive stuff, but that doesn't make it's a worse investment. Snowflake could be worth the premium price because it's accruing revenue faster than Datadog. Remember, Amazon made a great investment in early 2000s, despite sky high PS ratio, because it was adding revenue at such a rapid clip. Should dive deeper into understand whether one stacks better buy than the other. So, price to sales ratio. Mm, okay, anyway, price sales ratio is fairly low. Mm. Lowest among heavy hitters like Nvidia, Microsoft, Alphabet, Apple. Excellent option to buy now and never sell. Mm. Super microcomputer, Taiwan, semiconductor manufacturing, Alphabet. Okay. Hmm. Let's look at TSMC price. Hmm. TSMC. Hmm. Taiwan semiconductor manufacturing. Its sprawling ecosystem also includes the world's most popular streaming video platform. Google ties together all of those services with its own AI algorithms. It's been expanding into the generative AI market with Bard, Chatbot, and Gemini large language models. It's already one of the world's largest buyers of NVIDIA's data center GPUs, and it's been developing its own AI accelerators to gradually reduce its dependence on those chips. Alphabet's revenue only rose 9% in 2023 as Google advertising business struggled with tough macro headwinds throughout the first half of the year. However, its growth accelerated again in the second half as its cloud platform, which it's been biffing out with new AI tools, continued to generate double-digit sales growth with rising operating margins. So, analysts expect Alphabet revenue and earnings to grow 11% and 16% respectively in 2024. Those growth rates are stable, but it trades at just 21 times forward earnings, which makes it another cheap play on the growing A market. 21 times forward earnings. 21 times forward earnings. 21 times forward earnings. Forward price earnings. Forward price earnings. Forward price earnings. Forward price earnings. Forward. Forward price earnings. Forward price earnings. Forward price earnings. Forward price earnings. Ford price earnings. Oh, okay, PER. Earning ratio. And 21. Okay, 21. Hmm. Let's see what else we have. Microsoft here, Intel. Alphabet here, AMD here. Now let's see at Google. Alphabet was slightly over low last year as rivals Amazon and Microsoft seemed to progress faster in AI. So, however, the company was merely taking the time to own its technology as it prepared to make a big splash in the industry in 2024. Last December, Alphabet unveiled its highly anticipated AI model, Gemini. The new model excels at building generative AI programs um, with its ability to crunch various forms of data, such as audio, video, text. The tech giant has said it will release three versions of Gemini, with the most powerful one designed to run data centers and the smallest one able to power smartphones. Gemini could open the door to many growth opportunities in AI for Alphabet, with the technology to create a Google search experience closer to OpenAI's ChatGPT. Add new AI tools to Google Cloud and Android, offer more efficient advertising, and better track viewing trends on YouTube. Alongside the Gemini, Alphabet announced a new generation of its custom-built AI chips. The Cloud TPU V5P is a tensor processing unit designed to train large AI models nearly three times faster than previous versions. Over the last 5 years, Alphabet's annual revenue and operating income have risen 75 and 106%. Meanwhile, free cash flow has soared 151% to $77 billion. The company is one of the most reliable tech firms and is only just getting started in AI, which could further boost earnings in the coming years. Moreover, this chart shows that Alphabet is one of the cheapest AI stocks. Mm, okay. Palantir, Accenture, UiPath. We're not even through January. And shares on Nvidia are already up 24% year to date after soaring 239% in 2023. The company's business has exploded over the last 12 months as its graphics processing units have become the go to for AI developers everywhere. Mm. GPUs are crucial for training and running AI models, leading demand for its chips to skyrocket last year. Meanwhile, Nvidia rose over 80% market share in GPUs, made it well positioned to supply its hardware to most of the market. Despite in chip sales has seen Nvidia's quarterly revenue climb 200% over last year, with operating income up 729%. was valued at nearly $200 billion last year and is projected well exceed $1 trillion before the end of the decade. The sector's growth trajectory suggests chip demand will likely continue trending up for the foreseeable future. As a result, Nvidia could continue seeing major gains from its estimated 80% to 95% market share in AI GPU for years. EPS estimate align with Nvidia's potential. The chart shows its earnings could hit $24 by fiscal 2026. Multiplying that figure by the company's forward price earnings ratio of 50, it would just that price of $1,200, projecting growth of 97% over the next 2 years. Hmm. Yeah. So what much that's gravitating toward an all-time high could stocks been making a menacing buy. 3-for-1 stock split at the end of February. Stock split gets attention but don't change the fundamental of a stock. Walmart business has performed well in recent quarters, but the stock is pricey. Hmm. It's why they are paying off for the right kind of investor. Walmart is small buy. It's well managed, dividend paying, recession proof business. But if you are looking for growth or a stock that can beat the S&P 500 by a wide margin, there are better stocks to own. Anyway, this is it tonight. Happy Sunday night tonight. Tonight is Sunday night. Go sleep well. Bye bye.